Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Hannah Chu, Portfolio Strategist at Standard Chartered's Chief Investment Office, and welcome to today's Through the Noise podcast. So one thing that markets have been focused on is the tariff story, and what we've seen so far is that trade uncertainty has eased over the last couple of days, and markets have reacted quite positively to news that US and China will begin preliminary talks on trade. So there has been a lot going on here, and to help us make sense of the trade narrative so far and how investors can position themselves, I have with me Heung, our senior investment strategist at the Chief Investment Office. So Ray, welcome. And previously we've called for bargain hunting after President Trump announced a pause in tariffs a month ago, and we've seen risk assets rebounding. So what should investors do now?
Thank you, Hannah, for having me. In fact, on hindsight, this is actually a very, very bold call. Recording that the market sentiment was so bearish and when prices went riot in bonds, equities, and FX, we doubled down a week later, even after that call, and said that Trump put this back on right now. And we think that as Trump turned his focus towards sealing trade deals, and that equities will have further upside in the near term, especially when investors were still extremely bearish on equity markets in the US. Now, after a month, global and US equities have both rebounded about 14%. And yesterday, the UK has reached a trade deal with the US, and we expect Japan, Korea, India to reach interim trade agreements in the next few months. So what a difference a month has made. But now going back to your question, what should investors do right now? We believe it is the time to rebalance. While investor positioning indicators still point to further near-term upside in the US equities, we think it is time to use the US rally to rebalance towards less sensitive non-US markets, which are backed by typically policy support. And with this, China stands out, especially after this week's announcement that the US and China will start preliminary talks, and after China also unveiled new sets of policy easing measures. We also maintain our buy on dips idea on gold, especially if it falls to the region of 3,000 to 3,250 range.
Yeah, and I know you mentioned that the US and China will be having their talks this weekend, and I'm sure the markets will be closely watching it. So, what can we expect from it?
I think overall this is a very good icebreaker between the two nations, and after some tit-for-tat tariff increase between both sides. It is also clear to us that it's not easy for both sides to reach a comprehensive conclusion. But we do expect to see a partial reduction on tariff from both sides in the near term, and as a friendly gesture, given the current tariff will almost certainly bring trade between the two nations to a halt. But this discussion is also likely to drag on for a longer period of time. And to us, it will be a surprise if the two sides or the two countries could agree to a significant reduction in mutual tariff.
Right, and I guess as much as we've seen a lot happening in the trade talk space, we've also seen that this week China announced more stimulus measures, and I guess we just want to get some of your thoughts on these couple of measures. How should we think about the Chinese equity markets then?
Certainly, Hannah. China's latest round of policy easing is actually fairly crucial for countering the impact of the US tariff. The measures, including cuts to the reverse repo rate and also bank reserve requirement, are aiming to support the consumption-driven growth and enhance the technology sector in China. We expect also more targeted measures in the coming months to improve liquidity and help meeting China's growth target of around 5%. We will also expect further PBOC policy rate easing and a gradual weakening of the CNH. And we expect the US dollar CNH, may test the level of 7.7. Regarding Chinese equity, we remain bullish on China equities market, which currently is trading at around a PE of around forward PE around 11 times, and making it relatively inexpensive compared to other regions. And we think that as earnings improve, due to policy support and easing of the global tension, we do expect a positive re-rating opportunity for the market. We plan to add the Hang Seng Index below 22,000 and targeting 24,300 levels in the near term. And we also add the Hang Seng Technology Index below 5,000.
Right. So, okay, so to reiterate, you are bullish on the Chinese equity markets. So maybe just shifting gears a little bit to central banks, because this week we've had the FOMC and the BOE meetings as well. What we've seen is that the FOMC has held rates, while the BOE has cut rates by about 25 bips, right? So anything that investors should take note of?
Yeah, I think regarding the Fed decision, we think that is already highlighted by the Fed. They said that they are still very cautious against easing policy rate too soon, especially when we see the near-term inflationary impact of the U.S. tariff and also relatively strong labor market. But within our bank, our base case is still that the Fed will start cutting rates in the second half of this year, as we expect labor markets start to cool down. So whenever the US 10-year yield trading above 4.25%, we view as good opportunity for investors to add position into developed market government bonds. We would also recommend investors to look for additional yield over government bonds to add position on the US agency mortgage-backed securities. And regarding the BOE decisions, despite the weak, I think, so-called hawkish rate cut, we are also still relatively bearish on the sterling. We think the Bank of England to cut rates more aggressively than other developed market banks will be happening in the coming months due to the weakening growth and inflation trajectory. While the US and UK trade deals might provide short-term sentiment boost, and we see better opportunity in currency like Japanese yen, which remains supported by the Bank of Japan's policy.
Right. I think that was very that's very comprehensive. Thanks, Ray. I think that brings us to the end of today's conversation. So thanks, Ray, for joining us today. So just to close off, some key takeaway from today's conversation. I think number one is that investors can use the rally in US equities to rebalance towards less expensive non-US markets. And I think number two is that we can really look to buy on the dips for gold, especially if it falls to the 3,000 to $3,250 range. And I think just lastly is that investors can also look to add positions in the DM government bonds, as the US 10-year government bond yield should trade above the 4.25% range. And these are sort of attractive levels to really continue to add exposure at. So I think just thank you, listeners, for joining us in today's conversation with Ray and myself. We hope that you found this insightful, and we look forward to the next conversation that we have next week. Thank you so much.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.